Welcome to our Taking Stock video for the week ending the 10th of May 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome, Matt. Great to have you on board.
Thank you, Kien. It's always good to be joining you.
Likewise. But before we get started, just a quick yet important reminder, the information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, Matt, it's been quite a solid week for equity markets. In Australia, you had the RBA. They kept their cash rate on hold at 4.35% and indicated that the rates were at the right level to return inflation to its target range next year. And this provided some hope for investors, especially with interest rates that they're unlikely to rise anytime soon.
Yeah, Ken, although I did find that the relief rally of sorts was somewhat bizarre, given that markets weren't really expecting a rate hike from the RBA. And if anything, Michelle Bullock was rather hawkish in her tone. My personal takeaway is that if CPI data continues to come in hotter than expected, then the RBA will be prepared to actually hike rates this year. And in the US, the Fed also tried to dismiss ideas of a possible rate hike, but we cannot be too complacent at this current juncture. The main risk to equity markets is that rates will remain higher for longer, and this will impact the earnings forecasts and valuations for both US and Australian companies. Analysts are currently projecting that the S&P 500 earnings per share will rise some 17% this year, and we obviously are highly skeptical of these numbers.
Yeah, those numbers appear quite optimistic there, Matt. But changing perceptions on interest rates have also had an impact on companies within interest rate sensitive sectors such as retail. In fact, the sector to us remains quite vulnerable, with ABS stats indicating that retail sales contracted by about 0.4% in March. In fact, it was also a big week for retail, with a few large names, including Super Retail Group, JB Hi-Fi, and Baby Bunting releasing their trading updates. And the lag impact of rising rates, which we've been talking about, continues to have an impact to consumer spending, with, for instance, with like-for-like sales coming from Baby Bunting down 7.7% for the second half, even with the company offering further discounts to shift their stock. And this has led the company to downgrade their financial year profit guidance. And we believe it's still too early to be exploring opportunities in this stock, despite the large discount to valuation.
Yeah, they've been a continual disappointer, haven't they, Ken? And JB Hi-Fi also reported weaker than expected sales data for both March and April, which really could represent further downgrade risk to the already significant drop in earnings expected for FY24. And despite the above-market dividend yield at 6.3%, we believe the stock has not fully factored in the risks to earnings in the coming year.
Yeah, we've just got to be careful with that, Matt. And across to our portfolios, we had our Star Growth and Star Income stock, Super Retail Group, the owner of Super Cheap Auto, Rebel, BCF, and Macpac. Now, they reported a 1% decline in like-for-like sales for the fourth quarter. And it was the BCF segment which had the biggest drag on the sales. But if you include new store openings, sales were actually up about 2% so far for financial year 24. But earnings growth is likely to stagnate in the near term, and that's due to the rising wages they've been talking about. But we believe this announcement will have no impact to their dividend expectations, and the stock is trading on a forward gross dividend yield of about 7.7%. In fact, we believe that shareholders are likely to receive a special dividend at the financial year 24 result here.
And across to what's considered a more defensive end of the consumer or retail basket, liquor and pubs business Endeavour Group provided a trading update also. And they highlighted that the fourth quarter trading conditions were subdued, but there was a modest improvement, with retail up 0.7% and the hotel segment rising 1.7% for the quarter. This was effectively solid enough numbers for our analysts to have confidence that the company will deliver on that expected gross dividend yield of about 5.8%. Management has reaffirmed its capital expenditure commitments, and it's good to know that cost inflation remains under control, with its strategic program making the business more efficient. And although the ABS statistics suggest that Australians are drinking less, we believe top-line growth remains sustainable, driven by a lower comparable base and population growth. And in fact, we believe the risks are fully priced in at these levels.
Yeah, good point. That's why we've retained them in our star growth and star income stock universe. But looking to the week ahead, Matt, gaming and pokies machine maker Aristocrat Leisure, they are expected to release their interim results. So we'll be looking out for that. In Under the Microscope this week, we take a closer look at New Zealand Telecom's communication business, Spark New Zealand. Now, telecom businesses, they typically have pretty defensive earnings. However, Spark did announce a surprising earnings downgrade of around 4% this week. Matt, what led to this?
Well, the downgrade came on the back of challenging trading conditions, as we're all aware of. A notably weaker demand in the enterprise and government markets. And we understand that there's been some deepening of public and private sector spending cuts, which has resulted in a significant reduction in demand for IT services. And meanwhile, sales of the mobile devices and accessories has been softer than expected as high interest rates and cost of living pressures have dampened consumer spending. And in answer to that question around the defensive qualities of the business, Ken, remember that a telco's defensive income stream are only attributable to mobile voice and broadband plans, which collectively represent about 69% of Spark's first half earnings. The remaining segment will be more susceptible to the business cycle, of course, with varying degrees of impacts.
Yeah, that's a good point, Matt. It's important for investors to really understand the earnings breakdown under Golden Rule 7 as well. I noticed that the company's free cash flow, it remains well below the annual dividend payments. Also, the payout ratio appears incredibly high as well, Matt. Will this impact the sustainability of its dividend?
It's a good question. And although free cash flow is anticipated to fall below forecast dividend payments, Spark's dividends should be adequately funded by the company's excess cash from prior asset sales and the ongoing operating cash flow. Furthermore, management retained its full year FY24 dividend guidance at 27.5 cents per share, implying an unfranked dividend yield of about 6%. Also remember that the payout ratio is based on earnings, which is not useful in this case due to the capex requirements and significant levels of depreciation and amortization applied.
Yeah, and I guess this is the reason, Matt, we've kept Spark in our star income stock universe. Management also alluded to this earnings downgrade as a cyclical issue rather than a structural one, which gives us some reassurance that earnings will eventually recover. As a result, with the stock trading at a discount to the consensus price target, investors may view this share price weakness as an opportunity.
And over the long term, Spark has generated strong capital gains for investors. However, before considering exposure, investors need to be mindful of the ongoing active risks. The higher for longer interest rate environment could extend the weakness across the consumer and business spending cycle, and businesses may continue to cancel or defer technology upgrades. And additionally, increased competition and economic uncertainty may further impact Spark's near-term revenue.
Yeah, thanks, Matt. Also remember that on Stock Doctor, the forecast dividend may not match what's in the trading update, mainly because of the New Zealand currency to Australian dollar conversion. With the bank reporting season pretty much over, a question that is often asked among members this week is, what is our preference across the major banks? Well, the banks are currently on attractive dividend yields, ranging from the lowest with CBA on a forecast dividend yield of around 5.5%, and the highest being Westpac on a gross dividend yield of 9%. And you can use the peer comparison table to compare the bank metrics. Otherwise, refer to the star income stock watch list or build your own filters, which also can contain the forecast figures.
And we do believe that these yields are sustainable, at least for the next 12 months, as we're comforted by the fact that there is excess capital on the balance sheet, and that's allowed the banks to extend their share buyback programs and either increase dividends slightly or keep them stable. And meanwhile, the payout ratio does not appear to be all that stretched and lies within historical averages.
Yeah, good point there, Matt. And in fact, though, following the reporting season, we believe earnings revisions will be slightly positive. This is driven by the better than expected net interest margin outcome from the banking updates. This is the margins banks make on their lending rates less deposit rates. But moreover, despite an accelerating increase of the loans in arrears, that's pretty much bad debts across the sector, the banks were well provisioned into the lead up of this widely anticipated rise in later payments.
Yeah, very true. And despite the high for longer interest rate environment, the low level of current unemployment and the lack of housing supply should continue to support the asset quality across the banks. And we do see minimal risk of a significant rise in bad debts.
Yeah, but from a share price perspective, we do believe the rally across those banks over the last 6 months means that the good news may have already been factored into the share price, and it's now more difficult to generate similar capital gains from here over the next 12 months. So, banks from a yield perspective make sense, but from a capital gains, it's going to be very tough.
Yeah, I very much agree with that too, Ken. And the choice of which bank to choose from here on onwards is a tough one because it depends on an individual's risk tolerance and return objectives. For those who are more risk averse, however, CBA does carry that best cost advantage versus its peers and has a sizable exposure to business lending, which has been well placed in recent times. And it has the highest return on equity also at 14%. Due to this, the stock does trade on a lower gross dividend yield at 5.5% and trades at a premium to the other banks.
Yeah, and if you're comparing a CBA to Westpac, for instance, Westpac does have a more balanced exposure between residential and business lending, but the execution of its digital transformation strategy leaves it vulnerable to higher cost growth in the near term. And to compensate investors for the lower earnings growth, that's expected to be down by about 10% this year, investors are rewarded with a more attractive gross dividend yield at 9%.
Yeah, it was a welcome special dividend on top of the ongoing Ken, and as Lincoln Australian Income Fund investors will be happy that this is sort of helping us achieve our income objectives for the June quarter. And for those who want to focus their exposures more to businesses or institutional banking, they may want to consider the NAB or ANZ respectively. While they're both lending to businesses, the key difference here is the size of the loan value. NAB tends to focus more on the small and medium enterprise market with loan values normally below about 100 mil. Here in net interest margins are more attractive, double that of residential mortgages due to the added risk associated to a business.
Yeah, that's a good point. Just trying to distinguish between the two. Whereas with ANZ, they focus on loan sizes typically greater than 100 million, which have net interest margins similar to residential mortgages. This can contribute significantly to their loan book growth, although, of course, be mindful of concentration risk here. Moreover, ANZ does carry the uncertainty regarding the potential acquisition of Suncorp Bank as well. So from a risk perspective, our preference in order is Commonwealth Bank, followed by Westpac and NAB equally, while maintaining a lower weighting to ANZ on the integration risk would make sense. Anyway, that's all we have time for today. Thanks, Matt, for your insights. Very valuable.
That's my pleasure as always, Ken. And if you have any questions, please feel free to come along to our Lincoln Live webinar on Monday morning. Other than that, take care and have a happy, healthy and prosperous week ahead.